All right. Hello, everybody. My name is Michael Duke, and this is the channel where I take a look at stocks that are interesting. So if you find that interesting, consider liking and subscribing. Today, we're going to talk about Clearway Energy Inc. This is a company that I have covered once before. Um, it's been a good performer. The last several months, it's sold off quite a bit and recovered somewhat as of today since earnings. It's been a while since I've covered this. The last time I covered it was May 18th, 2025. You see here the article. Um, so we're just going to take a look at how things have been going numbers wise. As always, uh, there's going to be a presumption that you understand uh, a little bit about what the company does, given that I've reviewed it already. So I'm not going to go deep into what the company does compared to a video where I look at something for the first time. But as always, we're going to take a look at the financial results as well as the valuation, the dividend, discuss risk factors, and then also technical analysis very briefly, go into a grade, buy, sell, or hold. So without further ado, let's get into it. So May 18th, 2025, we did this review. Now you see the primary ticker was CWEN.A, which this company used to trade in two different classes of shares. Primarily, I was covering the A class. I like the A class shares better because they had voting rights. And if I remember correctly, Class C shares either didn't have voting rights or had less voting rights per share. And the A class shares happened to trade at a persistent discount to the other shares just because they were less liquid. But, anyways, that has recently been changed in March. So, about 5 months ago, the company announced a plan to essentially merge the two classes together into one class of common stock, and that would retain the collective voting rights of both classes in totality. So, in other words, each share has a lower proportion. Each share of the new ticker, CWEN, has a lower share of the voting rights that it did have before. However, it retains the same relative voting rights as the combination of both shares. Hopefully that makes sense what I'm saying. So I like that move. I think it's good. And plus, it makes it more simple for us to analyze. However, we don't have a rating history in here because the stock was here. We know that this is May 18th, 2025. So if we just kind of take a look at how the stock has done since then versus the broader market. Oh, I'm a little laggy this morning. Versus the broader market, May 18th to today. Okay, so no, hold on. August 13th. Okay, so in terms of price return, we have underperformed the market by 17%. Total return, however, we do know that this is a pretty hefty yield that it's got, 5 something% as of today. So total return, we've been about 10 points lower than the S&P. However, there was a demonstrable period of outperformance right here. Lower volatility and outperformance. One thing I've noticed about this stock here is that it seems to be more volatile than the index. So just something to keep in mind. We see that borne out from 52-week highs being in the low $40 per share, 41.74, and 27.67 a share on the 52-week low. So we're pretty square right in the middle of the 52-week range. But, $14 of variance over that low band, that's quite a bit of variance there. So just something to keep in mind. The shares have proven to be volatile, but not as volatile as some. So, anyways, let's take a look. As for why the stock was sliding here, it really isn't clear why that may have been happening. However, the stock has increased by about 15% from the local low seen at the end of July. So I think it's fair to say that the market has responded positively to the most recent earnings report. And the company did raise the dividend by, their standard, like 1.6, 1.7% quarterly raise amount. So the dividend is intact and continues to be raised at the clip that it has been. So let's just take a look at the most recent earnings report. Again, this is August 5th. This was released. It's about a week ago. Okay. Since last quarter, we have completed 2 additional accretive revenue contracts in our Texas operating fleet, received a drop-down offer for Honeycomb Phase 2, and our sponsored has secured over 2 gigawatts of new contracts recently signed for the 2027 to 2030 COD vintages, further crystallizing our long-term financial objectives. Again, just a reminder that this company is controlled by a sponsor. It's a yield co. Its primary purpose is to own the income generating assets that are generating power, sell them to the utility companies. However, it's controlled, and if you want to understand how the corporate structure works, again, with the old class of shares, then please refer to my original video where I in-depth break down how that looks. But for the purposes of this video, when we're talking about the sponsor, we're just talking about the entity that is in control, which I believe ultimately it's controlled by Blackstone or BlackRock in some sort of joint venture with a French utility. Okay. We remain in a very solid position to continue to strive for the top end or better of our cash available for distribution, very important metric, per share target for 2030 of $2.90 to $3.10 per share. We have line of sight now to the potential for 5 to 8% growth beyond 2030 from our 2030 target baseline. Continue to have the ability to generate further potential upside across all of our growth pathways, including through our co-located digital infrastructure business as it takes shape. Co-located digital infrastructure, in other words, powering data centers. The fact that they, announced that they intended to do that might have been a reason for the really bullish slide here. However, the co-located digital infrastructure business is kind of, it's not necessarily real at this point. So we shouldn't put too much weight onto that. That's more of a future thing. And you kind of see how management is guiding towards that. With the building blocks needed to fulfill our growth objectives increasingly in view, we are well positioned to maximize value for CWEN stockholders over the long term. While we are lowering our 2026 financial guidance due to factors outlined in our mid-July operational preview, our team is focused on maintaining our trademark operational excellence to uphold our historic track record of meeting our financial targets, says Craig Cornelius, the CEO. So let's take a look. Net income per segment, flexible generation. Flexible generation is natural gas, I believe. We had a loss in the quarter last year, 22 million this quarter. Renewables and storage, you see, we're down a little bit. And then corporate, I believe we're always going to show a loss there just because those are, I would imagine that we're paying fees to the sponsor to manage the entity. Something like that. Pretty typical private equity setup. Okay. Adjusted EBITDA, flexible generation down a little bit in the 3 months. Renewables and storage up over 20%. Very good growth. Adjusted EBITDA from 343 to 409, almost 20%. The 6 months ended up over 10% in adjusted EBITDA. The cash available for distribution, however, is what we really care about when we're, considering the dividend, right? From 152 million to 167 million, so 15 million, up almost 10%, roughly 10%. And then you see here the 6 months ended up 8 million over that time period. So, that's like 7%. Or excuse me, 3 to 4%. Okay. Okay. Megawatt hours in thousands. Solar generated and sold from 2,800 to 3,600. Okay. That's a 20-something% increase. And wind up slightly. Overall, we're looking at a roughly 900 megawatt hour in thousands. 900,000 megawatt hour increase in renewables and storage over a baseline of 6,000. So 15%. It actually says 16 here. 16% higher, primarily due to the contribution of growth investments. Okay. And then the liquidity picture, we see in terms of cash, we have a little less cash, a little bit more capacity in the revolver, roughly $1 billion of liquidity. Okay. All looks good there. Honeycomb Phase 2 in the third quarter of 2026, Clearway Group, that is the sponsor, I believe, offered the company the opportunity to enter into partnership arrangements to own cash equity interests. The 210 megawatt storage portfolio located in Utah, expected to reach commercial operations in 2027. The portfolio has been awarded long-term contracts with an investment-grade utility. So an investment-grade utility is going to purchase. And the potential corporate capital commitment for the investment expected to be approximately 110 million. Investment is subject to negotiation with Clearway Group and the review and approval by the company's independent directors. Okay. Chimney Canyon, the third quarter, Clearway Group announced a long-term PPA offtake agreement with an investment-grade utility for Chimney Canyon. 975 megawatt solar plus BESS project in Arizona expected to achieve commercial operations in 2029. Company estimates that its total potential corporate capital investment could be approximately 350 million. An investment decision for the project would be subject to receipt of a potential future drop-down offer from Clearway Group. Negotiation of such drop-down offer and the approval review and approval by the company's independent directors. So Clearway Group, again, is the sponsor. So what they're doing is they're creating corporate capital, they're investing in that, and then they're looking to drop it down into Clearway Energy. You see how this works now. Okay, the sponsor invests, drops it down to generate yield for the Clearway Energy shareholders. Company restructured its existing energy-related commodity contract associated with the Elbow Creek wind facility, which resulted in an in-substance financing to settle existing derivative liabilities over time. In connection with the restructuring, the company also entered into a 15-year PPA with a commercial counterparty, which replaces the volumetric and price exposure. So, in other words, creates more stable revenue from a variable structure. That's interesting. Company restructured its existing energy-related commodity contract with a different facility, entered into a 15-year PPA. So both of these restructuring from a volumetric contract into a PPA, so that stabilizes revenue. And then we declared a dividend, 0.475 per share. Okay. Clearway Energy's Inc. quarterly operating results impacted by seasonal factors, as well as weather variability, which can impact renewable energy resource throughout the year. Most of the company's revenues are generated from the months of May through September, as contracted pricing and renewable resources are at their highest levels. Factors driving the fluctuation in net income, adjusted EBITDA, cash from operating activities, and cash flow available for distribution include the following: higher summer capacity and energy prices from the generation assets, higher solar insolation, higher wind resources, renewable energy resource throughout the year, debt service payments, which are made either quarterly or semi-annually, timing of maintenance capex, the impact of both forced and unforced outages, timing of distributions from unconsolidated affiliates. So the big thing here is the company revised its cash flow available for distribution down somewhat, because basically what this reads as the renewable generation is a little bit down, didn't produce quite as much as they expected. That's just the name of the game when it comes to this asset type, right? I invest in solar energy for my own purposes. I understand how it works. It's just the name of the game. The fact that they're restructuring these two deals here, these are both wind, gives you an idea of their motivation. They're, striving to change their revenue into a more, lower risk, lower reward type deal, which is interesting. So, all in all, I think that these results are good. Again, when we're talking about an investment vehicle that has a yield above, a cash yield above the 10-year treasury by roughly 100 basis points, to see it grow far in excess of inflation, which it is. Something's growing 5, 6, 7, 8, 10, 11%. Plus you have that starting yield over the treasury. There's high total return potential. As always, this is not financial advice. It never is, just my opinion. As he takes a sip of White Monster. So just for a little bit more color, you can look at the earnings call insight here in Seeking Alpha. Reaffirming cash flow available for shared target 270 or better. So again, our dividend is 475 per share per quarter. We multiply that by 4. Again, they've been raising every quarter. but just a quick back of the napkin math. If you take the dividend that they're about to pay, multiply that by 4, that's $1.90. They're saying this is how much cash available for distribution, right? So assuming they hit those targets, which they've got a good track record of doing, we can say there's plenty of coverage for the sizable dividend, which of course gives us confidence in the underlying cash generative nature of the business. We still expect to deploy approximately $600 million of capital into this program at 11 to 12% cash available for distribution yields. In other words, they're going to get 66 to 72 million cash flow available for distribution off of that investment. So we know that they're using debt and equity. They're likely using debt and equity to do that. Okay. If we're deploying capital at 11 to 12%, we're doing good. And they've been pretty consistent about that's where they're deploying. If you've ever done a solar project before, you kind of play with the numbers, you do understand that's the kind of yield that these things put off right now. This sector has reached terminal velocity. The plane is off the ground. When solar and wind and stuff first started being built within the last few decades, is heavily subsidized. We're at a place now where the projects pencil, and companies like Clearway are making good cash flow off of these assets. There was something else I wanted to, right here. Over the 2026 to 2029 period, we continue to expect retained cash flows to contribute over $500 million, and corporate debt with over $1.5 billion expected to be raised, of which $600 million has already been raised. So in other words, what they're saying is we're going to retain cash, which is equity, but we don't have to raise equity. We're going to retain a quarter of the investment, or out of this $2 million, $500 million of retained earnings, $1.5 billion of debt, and then we're going to raise another half to $1 billion of equity. So we're going to issue shares, of which 50 million has been raised to date. And this will only be executed when demonstrably accretive. So in other words, right now they're paying out 5.5% to shareholders. If they're doing projects that are getting 11 to 12% on their money, that's demonstrably accretive if they equity finance it alone. But they're going to do it with a mix of cash from operations, debt, and equity. So again, because this is a yield code, effectively functions like a master limited partnership. The dividend exists so that they can raise equity continuously when needed. This is an asset heavy business with lots of capital needs. Okay. All of that sounds good though, to me. If we look at the financials over the last few quarters here, we do see, again, since May 2025 was when we looked at it, we've got about 90 million of revenue increase over that time. It's not exactly apples to apples because you see it's not just a straight line up. Like they were saying, in the wintertime, their revenue goes down quite a bit. And the summer months, spring and summer months, are where they're really making more money. But June to June is equivalent. So again, we've got roughly 90 million, 89 million to be exact, of increase over a 392 million base. That's, 20 something percent. That's really good. Operating income, we got a lot of depreciation and amortization in there because, again, they own hard assets. So you've got to treat that out when you're looking at these numbers. Operating income is not consistent. However, it does track that during those, summer quarters, it looks better. So again, because it's a yield co, they got lots of interest expense, they got lots of depreciation. We know that earnings really aren't a good metric to take a look at the financials. Revenue per share is relevant. We see that continues to go up, especially because our share count has gone up slowly over time. Again, June 2025 is the quarter we care about. 118 million to 121 million. So we really do care about revenue per share, anything per share, right? Earnings are not a good metric, as I said before. But revenue per share is. In June, we had 332 of revenue per share up to 398. That's 66 cents off of a 332 base. That's 20% per share growth over the last year. So again, numbers look really good here, in my opinion. Cash, we know that they've got the revolving facility. Cash is fairly consistent. Book value per share isn't accreting, really. We know that they've got depreciation, right? We see that here. This is gross property. They've added about $1.1 billion of property in the time where they've added that, 90 million of revenue. So that's, 8% on gross property. And we know that book value is going to count out depreciation, increases over time. Okay, long-term debt continues to tick up, not surprising. Current portion of long-term debt, current liabilities come way down. Current liabilities look fine. Now, here's one thing. Retained earnings have been trending down. Hold on. I got an email. Okay, we're good. Retained earnings, this trend, when we covered it last, we had, seen the same thing. However, been a little more volatile over the last year. So really the company's firing on all cylinders and paying all of its creditors, including stockholders. So again, this company exists to generate yield and has been exceptional in doing so. But given the trend in retained earnings, we do see that they've been outlaying the cash. They've been reinvesting all of it or distributing to shareholders. So again, they've continued to raise the dividend every single quarter. You see here, dividend growth was a little aggressive. They cut it and then resumed it at a little bit more gradual pace. What that's equated to is roughly 7% over the last 3, 5, and 10 years. Okay, so really, really strong dividend growth at these prevailing yields. Okay, the company is trading at the lower end of this range that it's established since, getting the dividend back in full swing. You know, I would say, high fives looks to be the average, maybe in the low sixes. We're at the low fives here, but we have come up off of this mid 4% range. Free cash flow yield is very accommodating. So all in all, I think all the numbers check out here. I mean, there really isn't anything about the numbers that scream, that things are off track. The company appears to be operating very consistently within its targets and within what we should be expecting it to do. If anything, the shares got a little overheated from this period here. I think that uh, the idea of, what do they call it, co-located power generation, in other words, supplying data centers with energy. I think that's a growth vector. However, they've really declined, as far as I can tell. Management's really declined to discuss and guide, at least in the most recent quarter, really guide to what that looks like, which I think is appropriate. They're just staying focused on what they got. Okay. So this is a very boring company. It's a very boring concept, and it's very consistent, which, I think nothing in everything in the financials looks good. We do see that the Seeking Alpha Quant is rating it a sell. However, strongly rated by the analysts, by the human analysts. Um, so ultimately, I don't see any cause for concern with them lowering their guidance. I think they made it pretty clear that they were just doing that because the renewable portfolio just kind of underachieved in terms of generation in the most, over the summer so far, and they're just bringing us back into a band that accounts for that. Um, I don't think there's anything wrong with that, especially because the dividend, in my opinion, is appropriate and within bounds of what they can afford, given their cash available for distribution. So if we just now kind of move into a technical analysis. Okay. So I really like how cleanly this chart is. We've got this long-term trend, this long-term uptrend intact, right? I mean, that's pretty much just zooming out all time. I wasn't even looking back here when I drew those lines, and they they hold, right? So when you look at it in terms of the very, very long-term uptrend, you see that we're pretty square in the middle of that, indicating, fair value. However, there's the other thing we have to kind of appreciate and acknowledge is the fact that there's a trend line here as well, and we can kind of come off that. There's this, somewhat more bullish, and we've seen this replicate a few times. There was one right here where we had more bullish momentum. We kind of failed all the way down to the long-term trend. Right now, we do see that the price right before earnings had touched on this, more parabolic trend line within this longer term uptrend. And we have bounced off of that. You see that here. We bounced off of that. Now, of course, what this longer term trend range implies is that if they are to miss their targets, if they are to falter for a quarter or two, in theory, there's a lot more downward pressure on the price until we hit that next level of trend line support. But as of now, those most recent results, which were strong results, however, in a quarter that they also reduced, they revised downward, and the market reacted bullishly to that. So if I'm looking at this critically, which I am, I feel like that is pretty strong evidence that this trend line is intact for now. However, if they continue to revise lower or whatever, in theory, this line here, very crude technical analysis as always. This line here, of course, might be the downside. So where we're at now, we continue to exist in this channel, this more bullish range. And for us to break above that into to basically continue this trend line up that we're on now, for us to continue on that path, we'll just have to cross that bridge when we come to it, right? We'll just have to see if that is something that we can accomplish without any sort of catalyst above and beyond our current earnings. And perhaps that is perhaps that has to do with the on-site power generation for data centers. They said that that's going to take shape, that's going to really start taking shape 3-4 years from now. Well, you kind of see where that chart, here's 2029, here's 2030, that starts to land kind of in this zone. Okay. So it would not surprise me if they continue to post just very average performance for what they're doing. They guide properly. They keep investors in the loop, hit their targets. I wouldn't be surprised to see it continue along this trend line here. This is the downside case. If we continue along this trend line, then there's probably some sort of catalyst needed to keep it going above the larger trend line there. Because once we get up into this range, again, our yield was in the mid fours right here. A yield lower than that, I think, is a little aggressive for this company. So technically, I think the chart looks fine. I think, it's modestly bullish. We've definitely got good momentum still. And obviously, it would have been a good buy down, in that low $30 range that it hit recently. But I think where it is now is, accommodating as well. So let's just discuss some of the risks. All the risks are really the same as they were in my prior video. The company is exposed to interest rate risks. If you owned 100% of these shares, you wouldn't control it. You wouldn't have full voting power. So it's always going to be externally controlled. So that's always going to be a risk factor. That's also always going to keep the yield a little bit higher than what it would be otherwise, right? So again, it's just classic yield co. It's got lots of debt. It's got lots of capex. As the equipment gets older, it's going to have to replace it. It's just capital intensive business. So it's sensitive to interest rates. It's sensitive to the demands of the sponsor. It's, all the risk factors are the same. In terms of any sort of near-term tailwinds, I don't really see the fact that they're lowering the guidance to really indicate any sort of impairment of the long-term cash generative nature of their assets. So yeah, risk factors are unchanged from what they were before. And I mean, we could even just kind of review what I think I articulated a little bit better. Interest rate risk and the capital intensive nature of the business, which have the potential to augment each other. Solar panels and wind turbines are famously capital intensive to maintain. And while there is potential For technology to improve, it is not really possible to quantify this curve. It is possible, but not in the context of what they own now and forecasting that out. I'm sure they have analysts that do that. As core assets depreciate and lessen in energy generation efficiency, this manageable phenomenon gets more challenging if interest rates continue to rise, given that the project level debt, meaning the subsidiary entities floating rate. Considering these risks, I think it is reasonable for investors to apply a bond proxy like estimation to the future of the Clearway shares. So yeah, I would reiterate that you have to look at this exactly what it's intended to be, a proxy for yield. We have a healthy risk premium over the 10-year treasury right now with a yield that's expected to grow. However, it's always going to trade with a little bit of sensitivity to interest rates, just based on how they're capitalized and what they own, which is fine. So that's the main risk factor. Okay, so I think we've covered everything. I think ultimately where it is now, I graded it a buy before. I still think it's a buy here. I think it's been a good performer. I think it's been a consistent performer. I like the yield. I like what they own. I like renewable energy. I like everything about it. Nothing about the financial results give me any pause. I'm comfortable with all of the risk factors, sponsor risk, interest rate risk, all that. I'm comfortable with that. I do own shares of this already. It's one of my larger positions, actually. I haven't added to it in a while. In fact, I haven't added to it in over a year, and it's done well. Lately on this pullback, I think it's a decent opportunity to consider adding a little bit more, just because the valuation is good. That was, I guess, one thing we didn't really look at is what's the valuation. Again, you can't really look at it in terms of a price earnings ratio. I think because it's a bond proxy, in my opinion, one must look at it through the lens of yield. We're kind of smack dab in the middle of what I would say is an acceptable yield. Pretty close to where it was when I last graded it, in that mid 5 range. It's a little bit lower today. So yeah, when it's down here and it's trading basically where the 10-year treasury is, I think that's too expensive. But where it is now, where it's got a healthy almost 100 basis point premium, I guess it's more like 70 basis points now. But still acceptable, especially when considering growth. I think the valuation there is fair. I also think we need to look at book value. Price book over 2 times. Again, we've got lots of depreciation, right? Where's our book value? $15 a share in terms of book value. That's been trending down. It's not really what we want to see. So it's not at like a super screaming deal valuation when you look at it as a pure asset, how much equity they have. It's more in terms of what the yield is. So I think the valuation is fair enough to keep it at a buy rating. However, it's not a screaming deal like it may have been in the past. So glad I remembered to discuss the valuation there. Anyways, that'll conclude the video. Hopefully you found this interesting, helpful, and instructive for your own purposes. Feel free to leave me a comment. Let me know how I'm doing. Feel free to give me a comment and suggest something you want me to take a look at. Happy to do that. And if you enjoyed this video, please consider liking and subscribing to the channel. And that'll conclude our video today. So hope you had a good time, as I certainly did. And I will talk to you soon. All right. Have a good day. Bye.